Hi everyone, and welcome to this video on credit card interest rates. Today, we're going to talk about the difference between APR and interest rate, how credit card interest rates are calculated, and why they're typically over 20%. Interest rate, in the context of borrowing and lending, is a fundamental financial concept that represents the cost of borrowing money, or the return on investment for lending money to someone else. It is expressed as a percentage and is a crucial factor in determining the overall cost of a loan or the earnings on an investment. When you borrow money, the interest rate is applied to the principal amount, which is the initial sum you borrow. This rate represents the compensation that lenders receive for lending you the funds. Interest rates can vary widely and are influenced by several factors, including economic conditions, market interest rates, and your creditworthiness. For example, if you take out a $10,000 loan with a 5% interest rate, you will be required to pay $500 in interest over the course of a year. This $500 is essentially the cost of borrowing the $10,000. Loans can carry extra fees and the lender may choose to borrow the funds to lend to you. And the lending costs, as with APRs, are passed on to you as a set fee. Having a low credit score incurs those extra interest fees or higher interest charges. The breakdown of APRs can be a lot, but you should always ask for the final APR, as it can be listed at 20% APR but carry 3 or more carrier costs, or fees like the lender borrowing the money to give to you, the lender's operations cost for the loan, split origination fees from the lender, and the company they borrowed the funds from. It can keep going with other fees, so be mindful of who you are borrowing from, but let's do a deeper dive into what is APR. The annual percentage rate, APR, or total cost of debt evaluation, is a comprehensive measure of the cost of borrowing money and is designed to provide borrowers with a more complete understanding of the financial implications of a loan. Unlike the interest rate, which only considers the cost of borrowing the principal amount, the APR incorporates a broader range of expenses associated with a loan. In addition to the interest rate, the APR includes other fees and charges that borrowers may incur during the loan process. These can encompass origination fees, appraisal fees, credit report fees, and more. Essentially, the APR gives you a more holistic view of the financial commitment associated with taking out a loan. For instance, if you're considering a loan with a 5% interest rate but also involves $1,000 in origination fees for a $10,000 loan, the APR would reveal that the actual cost of the loan is 6%. This is because the APR accounts for not just the interest but also the additional costs associated with obtaining the loan, making it a more accurate representation of the loan's true expense. The key differences between the interest rate and APR are essential to understand when evaluating loan options. Interest rate. The interest rate, expressed as a percentage, represents the cost of borrowing money based solely on the principal amount. It does not include any additional fees or charges associated with the loan. APR, the annual percentage rate, also expressed as a percentage, encompasses the total cost of borrowing money over a year, including the interest rate and other fees or charges that may be applicable. It offers a more comprehensive view of the financial commitment associated with the loan. These distinctions are critical because they help borrowers make informed decisions about loans. While the interest rate gives insight into the core borrowing cost, the APR provides a more comprehensive overview of the entire financial commitment. Understanding both can empower borrowers to choose the loan that best suits their financial needs. To get the best APR on a loan, it is important to shop around and compare offers from multiple lenders. This can be done online, through banks and credit unions, or through mortgage brokers. It is important to compare not only the APR, but also the terms of the loan, such as the repayment period and any fees that may be charged. Another way to get the best APR is to get pre-approved for a loan before you start shopping. This will give you an idea of the interest rate and APR you qualify for, and it will also make the shopping process easier. When you get pre-approved, a lender will review your credit and financial information and give you a preliminary offer. Finally, be sure to ask about any discounts that may be available. Many lenders offer discounts to borrowers with good credit, who bundle multiple loans, or who make automatic payments. Here are some additional tips for getting the best APR on a loan. Improve your credit score. A higher credit score will qualify you for a lower interest rate and APR. You can improve your credit score by paying your bills on time, keeping your credit utilization low, and avoiding unnecessary credit inquiries. Negotiate with lenders. Once you have received multiple offers, be sure to negotiate with the lenders to get the best possible terms. Don't be afraid to walk away from an offer if you're not happy with it. By following these tips, you can increase your chances of getting the best APR on a loan. How does APR apply to the use of credit cards? Here is a breakdown of how credit card interest is calculated. Calculate the daily APR by dividing the APR by 365, the number of days in a year. For example, if your APR is 16%, then your daily periodic rate is 0.16 divided by 365 is equal to 0.00044. Note that some credit card issuers use 360 for this calculation, so it's best to check with your card issuer to confirm. To determine your average daily balance, start with your balance on day 1, including any carried over debt from the previous month. Then, calculate your balance for each day by adding the card's balance at the start of the day, the day's new charges, the day's payments and other statement credits, and fees related to today's transactions. Once you have the balance for each day, calculate the average by totaling each daily balance and dividing the sum by the number of days in your statement cycle. Multiply your daily periodic rate, from step 1, by your average daily balance, from step 2. For example, if your average daily balance is $1,200, the calculation would be 0.00044x $1,200 equals 53 cents. Next, multiply this daily interest amount by the number of days in your billing cycle. For instance, if your billing cycle is 30 days, multiply 53 cents by 30 to get $15.90. This means you'll be charged approximately $15.90 in interest for the billing cycle. Keep in mind that most credit card issuers compound interest charges daily. This means they add interest charges each day based on your previous day's balance, using it to calculate your total interest due each month. Although it's time-consuming to factor in compounding manually, it's relatively minor within a single month. The previous outline should give you great insight into the process and will be a good estimator for you to practice with. Tips for avoiding high interest rates and compounding interest. Consider paying off your balance in full. If possible, it's recommended to pay off your credit card balance in full each month. By doing so, you can avoid accumulating interest charges altogether. This is especially important if you have a high APR or carry a significant balance. Understand the impact of minimum payments. If you're unable to pay off your balance in full, make sure you understand the implications of making only the minimum payment. Minimum payments usually cover the interest charges and a small portion of the principal balance. By paying only the minimum, you'll likely carry a balance forward and continue accruing interest. Review your statement carefully. Take the time to review your credit card statement thoroughly. Look for any errors, unauthorized charges, or fees that you may need to dispute. Familiarize yourself with the different sections of the statement, such as the transactions, fees, and interest charges. This will help you understand your overall financial situation and make better decisions. Consider alternatives to high-interest credit cards. If you find yourself consistently paying high levels of interest on your credit card, it may be worth exploring alternative options. Look into low-interest credit cards, balance transfer offers, or personal loans with lower interest rates. These alternatives can help you save money on interest and manage your debt more effectively. Remember, loans are one upfront cost and certain credit cards offer balance transfers at a 3 to 5% charge with 0% interest for a certain period of months or a year. Seek professional financial advice if needed. If you're facing significant credit card debt or struggling to understand your financial situation, consider seeking advice from a financial professional. They can provide personalized guidance based on your specific circumstances and help you develop a strategy to improve your financial health. Remember, using credit cards responsibly and understanding how interest is calculated can help you make better financial decisions and avoid unnecessary debt. By being proactive and informed, you can take control of your finances and work towards a healthier financial future. Getting the best APR. When it comes to credit cards, there is no APR negotiation like with traditional loans. The issuer sets the APR, and it's generally based on your creditworthiness. However, there are still ways to make sure you're getting the best APR available to you. Maintain a good credit score. A higher credit score usually leads to better APR offers. Make sure to pay your bills on time, keep your credit utilization low, and avoid unnecessary credit inquiries. These actions can help improve your creditworthiness and potentially qualify you for lower APRs. Opt for credit cards with introductory 0% APR. Many credit card issuers offer promotional periods where you can enjoy 0% APR on purchases or balance transfers for a certain period of time. If you're planning a large purchase or want to consolidate your existing credit card debt, taking advantage of these introductory offers can save you money on interest. Be mindful that looking for new credit can hurt your credit score as well, so seek help with what steps you need to take. Transfer balances to lower APR cards. If you're currently carrying a balance on a high-interest credit card, look for opportunities to transfer that balance to a card with a lower APR. Some credit card issuers offer balance transfer promotions with low or 0% APR for a specific period. Just be aware of any balance transfer fees associated with the transfer and make sure it's a viable option for saving on interest. Consider credit unions or community banks. These types of financial institutions often offer competitive interest rates, including lower APRs on credit cards. If you're not satisfied with the APR from traditional banks or major credit card issuers, exploring options with local credit unions or community banks might be worth considering. By following these tips, you can increase your chances of obtaining the best APR available to you and minimize the amount of interest you pay on your credit card balances. Thanks for watching. I hope this video helped you to understand the difference between APR and interest rate, how credit card interest rates are calculated, and why they're typically over 20%. If you have any questions, please leave them in the comments below. Don't forget to like, share, and subscribe to the channel for more updates like this.